Let's talk about cell phones. You're running a business. Yes, your cell phone is for personal use. Yes, your cell phone is for business if you have one phone. So here's the thing. If you have a business, you can write off a portion of your cell phone bill. How much of your cell phone do you use a day? Just take a percentage and write it off at the end of the year. If your cell phone bill is $5,000 a year, you take what, 10, maybe 15, maybe 25% of that cell phone bill and you write that percentage off.
So, welcome back to the How to Sell Dope podcast. This episode right here, especially closing out the year, I think is extremely important. I sat down with Michelle Dorsey of Prosperous Accounting Services, and she dropped so many gems. There's a lot of money out here that you all leave on the table when you don't set yourself up as a business, because as an artist, you are a business. And I keep talking about this, and it's like once you get that in your mind, you understand that, okay, my studio time is a write-off because it's a business expense, or shit, even my internet at home is a write-off because it's a business expense. So all these different things are available to you if you set yourself up as a business. And I encourage you all to check out this podcast. Michelle is going to tell you how, and definitely hit her up if you need to make that change in your life and tell her I sent you. Let's get right into it. Okay. So let's back the bus all the way up. Thank you, Jada, for being a dope individual and letting me know. So yes, welcome to the How to Sell Dope podcast, where we're not talking about selling drugs. We're talking about talent here. I have a very special guest today, Michelle Dorsey. She is a tax professional here to get you right. Now, just to let you know, Michelle, the goal of this podcast is to really spark some interest. I think creatives are really good at creating. A lot of creatives aren't really good at business. I think if you have the business gene, you're really good at doing business, but you may not be that creative. Some people are blessed to be both. I like to think that I am, but may be biased. But either way that it goes, I think people can benefit from the creatives, at least that I work with, can benefit from just, a different way of thinking. And hopefully some of the conversations that we have can spark some ideas. Mm-hmm. So with today's podcast, well, first and foremost, Michelle Dorsey owns Prosperous Accounting Services. I think it's dope that you have your own company. And I guess where I want to go with today is how can people turn themselves into a business, right? Like I know recording studio, coming to the studio costs a lot of money. To shoot a music video costs a lot of money. When you start thinking about marketing, like Facebook ads and, Instagram ads, Google ads, even transportation to and from, like you got to have internet at home to, download beats or send files or whatever. Like I think a lot of this stuff can be expensive, but there may be a way that you can write some of this stuff off at the end of the year if you decide to incorporate yourself as a business. So maybe we should start off with talking about what are some of the ways that people can incorporate themselves. Like I don't know them all. I know, I've heard, I have an LLC. I know about sole proprietorships. I know, I think it's S corps. There's a few different things or different ways that I've heard, but can you maybe list those and why they would be beneficial for someone to do?
Okay. Yes. So the better one that everybody normally uses is a sole prop. And that right there is just they're identifying themselves as a business to say that, hey, I have a business. I'll write this off on my on a Schedule C along with my tax return. So it's nothing really expensive about that. Is no money given to the state or anything. So a lot of people like to go that route first when they start their business, because they want to see how the business is going to go, how much revenue they're going to make. The next one is a LLC. And with the LLC, you can be a single, a disregarded entity, which is a single member entity, or you can be a partnership LLC, or you can have multiple members. And with a disregarded entity, it commingles with your personal tax return. With LLC, where you and somebody else are in a partnership, that's totally different. You're going to file a 1065 with that, which is an informative form, and both you all are going to receive a K-1 form with whatever your percentages are to add on to your personal tax return. The next incorporation is a C Corp. A C Corp is its own entity, and it's the liabilities and the taxes are totally different. And with a C Corp, you file a 1120, and that's all on the business. If somebody wants to sue you, they're not suing you, they're suing the business, the C Corp. The C Corp has nothing to do with you, the person. It's only the business. Then you have our special S Corp. Our special S Corp, you have to get authorization to become an S Corp. So once you incorporate as a C Corp, then you fill out a form and submit it to be able to be incorporated with a C Corp. However, it's tax liabilities as well with that. So you're going to fill out a 1120S form during tax time, and then you're going to receive a K-1 form with whatever your deficit or your surplus was, and you're going to add that K-1 form over to your 1040 tax form, and it's going to be commingled. So it's very important, whereas though the ones that's commingled with your personal tax return, that you have a good bookkeeper that's going to do your bookkeeping for you on a monthly basis, because he or she will be able to tell you, like I tell my clients now on a monthly basis, I let them know what, every time I do their bookkeeping, how much estimated taxes they're going to have to pay to the state and to the feds, and when they should pay it. Also, we have non-for-profits. So let's not forget about non-for-profits, because non-for-profits is out here doing things, helping people. And with non-for-profits, you can become a 501c3, which is great tax write-offs with the 501c3, but also non-for-profits are scrutinized. So you have to be very careful with these businesses. And then also, once you become a business owner and you pick one of those entities, you have to make sure that you're following the regulations and you're doing your annual documentation and annual paperwork, because also your business can become involuntary dissolution, which you don't want to do that, because it's a lot of money to get it back reinstated. And you call an accountant, you call me, it's a lot of money.
Okay. Okay. So you just dropped a lot right there. Okay. So I have some questions. The first thing that you mentioned, I thought it was S Corp, but now I feel like was it Soul Corp? What was
a Soul Prop. Soul Prop. Mm-hmm.
Okay. Has anyone ever gone from maybe an LLC partnership to a Soul Prop? Is it possible if the situation changes? Because I feel like that's a personal question. I'm just curious, but
okay. So here's the thing: you would never want to do that. I would never suggest that. You start off being a sole prop. Okay. So let's say you're turning your hobby into a business. So when you turn your hobby into a business, it's a sole prop. Keep it a sole prop for 6 months, a year. I say after a year, that's when you start making 20, 50,000. So in a year, you're making 20, 50,000. So now you have truly turned your hobby into a business. So now you're not a sole prop anymore. You rocking and rolling. You got that 50,000. So now you say, hey, let's do an LLC. Then you're doing real good after another year. You make 200,000, and then you just keep it moving, or you keep it at an LLC.
Okay. Um, okay. So that's dope. Now you mentioned, some of the annual filings, right? That you got to make sure you keep up
Yes.
with. So I guess my next question would be, when would it be, like, is there a threshold, right? Like, if you're someone that you're trying to do the music thing or whatever your creative path is, you're not spending that much money on it. Maybe you come to the studio, maybe just a couple times a year. What is there, like, a financial threshold where you think it would be more beneficial to incorporate yourself, or, if you're not there yet, maybe just don't think about it until you get to that point?
So here's my thing. So the law says, I'm gonna tell you two scenarios, what the law say, and I'm gonna tell you what I also say that won't get you in trouble. So
Okay.
here's the thing. I mean, anytime you make $600 and over, you have to report it. Okay. But here's my thing. You're turning your hobby into a business. So when you're turning your hobby into an actual business, and let's say the first year you only made a couple $1,000s, but you had more expenses. Here's my thing. Keep it as a sole prop, because you're going to put that on your tax return. You're going to put the little revenue that you made. You're going to add the expenses. Of course, the first year, you're going to always have a lot of expenses. So I say, whatever's comfortable to you, because I tell all my new beginning clients, if you're trying to create this business, you're going to we're going to start out doing a budget, because you're going to know what your budget is going into this business. So once you see that you're close to your budget, I tell people, when you start making like between 5,000-10,000, then hey, let's start incorporating this company. Because if you're making that, then you need to start putting that business on paper and having documentation. That's my suggestion.
Okay. So now I hear you on all of that, but the reality is, as an artist, it takes a little time before you make money. You're probably going to be losing more money in the beginning than you are making, as you're trying to build your name and build your value. So I guess that's why I think, especially like in the beginning stages of your artistry, where you're spending all the money to, get sonically, you're trying to figure out your sound, you're trying to figure out your image, you're trying to do all these things. It may be good to sole prop as you're going along, so you can, because you're probably working a job,
Mm-hmm.
and then you can still use those expenses as things that you're getting paid from wherever you're working, and you're coming out of pocket for all this stuff. You can still write off those expenses if you're not making any money just yet as an artist, or little to no money.
That is true. As long as you can, I know I have clients that was a sole prop for about 4 years. And that's fine. As long as you are adding that to your tax return, you're good. There's no limitations on when you should be a sole prop. My thing is, I put limitations on it because depending on your business, whatever business you have, let's say you're over the road truck driver or HVAC company. If you start making a certain amount of money, you do want to incorporate that business, because you also want to make sure you get the insurance, you have liability and all of that in place. But let's say you are a musician or a nails tech or something like that, then yes, you can be a sole prop and still just claiming those expenses and that revenue on your Schedule C form. It all boils down to make sure you claiming what you receive, and make sure you're putting on your return what you're dishing out, because it's going to help you in the end. Because let's say 1 year you just have a magnificent year and it's amazing, and hey, you go out for a business loan or you're trying to get something for the company because you are a business owner, whether you're a sole prop or you're actually incorporated, they're going to ask for your tax returns. And that tax return is going to show, hey, here's the revenue, here's the expenses. They're legit, whether you are incorporated or not. So you can be a sole prop for 4 or 5 years. It doesn't even matter, long as you're doing the proper reporting on it.
Okay.
And keeping the proper books.
See, and that's another thing too that I wanted to hit on. You said the proper books. Well, you know what? Hold on. Actually, let's not go there just yet. So, what are some of the things that people can write off? Because I had tweeted something. I want to say back this summer sometime, and I said, people complain, and I'm going to watch the way that I talk moving forward, because I think sometimes you can say things and people take offense to them. But, I was saying, instead of complaining about the cost of these services, if you actually incorporate yourself, you can start writing this stuff off. So now this is a tax break to you. You get more back at the end of the year if you file this as an expense. If, and I feel like the door opens up to claiming more than just coming to the studio or the video. I keep using those examples, but now it's like, okay, you have a phone that you need to call people with. You need to call and either schedule your studio sessions or talk to your videographer or talk to your manager or book your tour or whatever. You also need the internet to send these emails back and forth. And a lot of, there's transportation to get to and from, and like all these other things that may already be a part of your daily life that you aren't thinking about. You may also be able to claim those as well. Is that correct? And can you maybe give me some ideas of what some of those things may be?
So being a business owner, you can write off a lot of things. A lot of people don't know like how much stuff you can write off. The only issue is that a lot of people don't keep the support, the receipts, the invoices, do things through their business bank account. If you do things through your business bank account, you have a bank statement. That's going to help you. You have the debit card or the credit card transactions. You have that. You have to keep that. As long as you have that documentation, you're good. Let's talk about cell phones. You're running a business. Yes, your cell phone is for personal use. Yes, your cell phone is for business if you have one phone. So here's the thing. If you have a business, you can write off a portion of your cell phone bill. How much of your cell phone do you use a day? Just take a percentage and write it off at the end of the year. If your cell phone bill is $5,000 a year, you take 10, maybe 15, maybe 25% of that cell phone bill, and you write that percentage off. If you're using your home, if you do not have an office outside of your home and you're using your home for your office space, then you take the square footage of your entire home. Also, you take the square footage of the room that you're physically using for your office, and then you use that, okay? Because we're going to need, us accountants are going to need those 2 square footages. Then, how much is your rent? I need the total amount annual of your rent, utilities. If you have a cable bill, an internet bill, I need that, because what's going to happen is that's going to become indirect costs. And then the percentage from your square footage of the entire home to the office space, we're going to take a percentage of that. And then it's going to calculate what percentage of your home office space can be written off. So that's a lot that people don't understand. Let's talk about vehicles. Hey, if you have an office space at home, you leave your home and go to a client, you leave your home and go to the store for business purposes, it's a write-off. It's a write-off. You just have to get an app. They have apps. A lot of my clients use Miles IQ. Me, I'm a paper girl. I write my miles down, keep a calendar of where I go, and track it that way. All you need is that if you get audited, hey, I'm going to ask you for that during tax time, that log. You print that log out and you're tracking all your miles. All you have to do at the beginning of the year is put your total miles, what the odometer says in the beginning, and then what the odometer says at the end, and you can write that off. You write off tolls, you write off parking fees, you write off all that stuff. And I always tell people, you take the standard mileage on tax returns. People always say, no, I want to take the actual. Remember this, if you take the actual mileage on taxes, you can never go back to the standard. And 9 times out of 10, the standard is always going to get you more money. So that's another thing you have to think about. If you have an office outside of your home, then you can write off all that rent. That's your office space. If you pay utilities at that office outside your home, you write all that off. Office supplies, you write it off. Let's talk about renovation versus repairs. If you have an office and you say, oh, I want to renovate. No. We don't use renovation. We use the words repair. Something has to get repaired. Because when I see renovations, no, they frown on that. I deal with the IRS so much. I know we don't do renovations. We do repairs. Okay. So you can write that off as well. Fax machines, internet. I mean, let's say like we have meetings with clients, and sometimes we want to get out the office and we want to go have a bite to eat. Hey, let's have a drink. Let's talk about business over drinks. Let's talk about business over food. You pay for it. You get that receipt and you put who you met with, just a blurb of what you all discussed. You take that receipt to your accountant, me, Prosperous Accounting Services. I do your bookkeeping and we put it up under conferences and meetings. And the whole amount, let's say the bill was $150. You put that on your tax return, they're going to take 50% of it. The IRS cut food costs to 50%. Travel. Just went out of town and you talk to 1, 2, or 3 different people when you go out of town, and hey, you can take 5 to 10% of your travel costs. You just have to learn how to commingle what you're doing with your business. So you talk to people about business, you help people about business, you give them some pamphlets, you give them some information. It's easy to just go and talk to certain people about business when you're out of town. You just get in that communication flow and you'll be able to write off some portions of that travel. Sometimes it's just all fun and you don't want to do it. That's fine, but you have to learn ways of being able to write things off.
And travel, Uber is that? I have a friend that is a comedian and out in LA, and I know she Ubers back and forth like crazy to like different shows and whatnot. And is that also something that can be written off?
So she Ubers, so yeah, she can write off Uber fees, and yeah, she could just say Uber cab fees and write those off.
Okay.
Because she's a comedian, and see that right there, you know, you have to go back and forth. So yes, and then you can log on to Uber and get your printout. As long as you have sufficient documentation.
You know, you had mentioned going to restaurants and having drinks. Is there, and keeping that receipt, is there like an app that you suggest people do, or take pictures of the receipt? Like, what is the best way? Because I will get a receipt, and then when I go home and empty out my pockets, I'm just throwing it away. I ain't gonna lie. Like I want to be better at that, but it's difficult.
But that's why you need a bookkeeper, because my thing is with my clients, what they know, if they have receipts, they email me their receipts as they go or on a monthly basis. So what you have to do, a lot of people take pictures of those receipts. It is apps out there. It's also a scanning app. You can scan the receipts into yourself because, you know, after a week, the receipt get old and it starts fading. Mm-hmm. So you can either take a picture, you can use the scanning app, you can use the app just to keep your receipts and documentations on there. You can copy your receipt. It's up to you on how you want to keep those receipts, but you keep them all together. And I tell people, don't just dump them somewhere. You log them together. So keep all of your conference and meals receipts together. Keep all of your office supplies receipts together. Keep everything organized. That way, when it's time for bookkeeping, when it's time for taxes, whether you're doing your bookkeeping or I'm doing your bookkeeping or whoever is doing your bookkeeping, they can get your information. You have a total. Hey, here's all my office supply receipts. Here's the total of them. It's easy because no one wants to go through a box or a bag full of receipts at the end of the year.
Yeah. Yeah.
Been there, done that.
Yeah, I don't even want to do it at the end of the week. So I'm gonna get better with that. You just dropped a lot of gems there, and I think hopefully people are listening to that because there's so many benefits now. It's like, okay, now you spent $300 on a studio session, but again, if that came out of your pocket and you've actually incorporated yourself as a business, there's a lot of breaks that you can get on that. There's a lot of breaks that you can get on everything that you're doing. Now, one thing I would like to ask. So, let's just say, because I've recently talked to a loan officer. So now if you're in a situation where, okay, I'm trying to buy some property or, I need to, get a car or something along the lines where they look at your annual income versus expenses or your debt, what do they call it? Debt to income ratio.
Debt to income ratio.
It may be a better idea to not claim as much when you know that you're trying to make a bigger purchase, correct? Not to claim as many expenses because they could be used against you.
Yes. So here's the thing. It depends on what bank you go to or what lender you go to. Everybody has their own rules. I had 2 cases just recently within the past month and a half. Two people one person was trying to purchase a house. Another person was purchasing a trailer or something. And the one that was purchasing a house went to 2 different banks. This one bank told him that he had too many expenses. Another bank told him he didn't have enough expenses. So it just really depends on who you go to. But here's the thing. You have to analyze what you're trying to do, what you're trying to purchase. And if it's a house, you have to look at that house and the taxes, and you have to, or if it's a vehicle, see, with your revenue on your tax return minus your expenses, does that leave you, let's say the house is about $100,000. Is that going to leave you with about $7,000 worth of income per month? If not, then you know that it's a slight chance they're going to reject you because they're going to say that, hey, you're not going to make this income to debt ratio. So sometimes if it's like 250, 300, they're going to want your income to be between 6,000, 7,000 a month. So it just all depends. But I tell you, if you know you're going to make a purchase, you need to really, really, really analyze your revenue and your expenses when you're running a business.
Which leads me to my next question. I'm sorry I am this way. I feel like there are workarounds to certain things. So let's just say, for instance, I just eat all of my expenses this year to make sure that my debt to income ratio looks lovely, and I get what I want because I have a problem with mortgages. I'm kind of, if you can't tell, I'm in the process of looking to purchase something. So the way they do things, the fact that I pay whatever I pay for rent, and I've done it on time without any hitches for 10 plus years, I think that that's worth something. But a lot of times they don't. They feel like you need to get what they give you. So if is there a scenario where, okay, I take an L this year, right, and I come like Michelle, I got my house now, I'm doing good. I think I may have made a mistake last year on my taxes. Is there any way to like amend that or something? I think I might have bought a little bit. I spent a little bit more than I claimed for whatever reason. I got amnesia. I left off about 16,000 or something somehow. I don't know. But
so here's the thing: when you're going after a purchase and you know you're trying to make that purchase, it is not a good idea to do an amendment to your tax return when you know you're in the middle of trying to make a purchase. Let me tell you why. That lender is going to ask so many questions on, well, why you just did it? Why did you just start making this amendment? Or let me see, they're going to ask questions, you're going to be rejected. But
no, I'm saying after the fact. After the purchase, yeah.
Yeah, people do that all the time, unfortunately. People do it all the time. They hey, let me hurry up and make this purchase. Let me do my tax return the way that they want to see it, just so I can make this purchase. They do it all the time. I'm gonna be honest with you. I've seen it, and I look at them and be like, tell me the truth of what happened. And they tell me. They do it all the time. And then once they make the purchase and everything is good, they sign the papers and they got whatever that they needed, they come back and we just amend their taxes to, hey, here's your expenses, here's this, and we amend their taxes. And the only downside to that is that you may, because it depends on how much you're going to owe. After you put your interest and stuff like that, the government, if they got to give you money back, they going to add some type of interest or something. So that's the only downside to that, interest and penalties, the only downside to that. But yes, any and everyone can always go and do an amendment.
Okay. It's good. It's good to know. Good to know. I'm sure you all are happy to know those things too. So I guess if anyone has any questions, feel free to start dropping those in the comments. Now you said that you actually offer a monthly bookkeeping service. So as well as I feel like everything that we talked about today, these are all different services that you offer for people, right? So if I came to you and I'm like, hey, I want to turn myself, I go by Ignat, I want to turn myself, Ignat, into a sole prop, I could come to you and you'll see that through for me.
Yes. So I help people incorporate, I help people sustain their business. Whether it's a for-profit or non-for-profit, I do 501c3 paperwork, bookkeeping, payroll, in-house auditing, tax prep for individuals and also organizations. I do financial literacy, insurance audits, bookkeeping. I do all of that.
I'm really interested in this bookkeeping, this monthly bookkeeping idea. Like, explain to me, I guess, in detail, like how that works. Like is it just we talk weekly, or is it just I'm going to give you a Dropbox file and you put all your stuff in there, or I just keep an eye on your bank statement? Like how does that work?
So I have clients that do it different ways. So here's the thing with bookkeeping. Bookkeeping is done under my business on a monthly or quarterly basis. Okay. And so basically what happens is this. I have access to about 80% of my clients' bank accounts. So I do it myself. And then the other 20%, they send me their bank statements and all their information with different commentary on it. Okay. So on a monthly basis or quarterly basis, I enter into my accounting system all of their revenue and their expenses, very detailed information. And at the end of the month or the end of that quarter, whatever agreement they're on, they will receive a P&L, which is a profit and loss statement, and a BS, which is a balance sheet from me. And it'll match up to what their bank accounts state, unless they have credit cards and all this other stuff going on. So we'll commingle everything. So every account that they have, I'll take care of that at the end of the month or at the end of the quarter. Normally on the 15th of each month, I send them all of their profit and loss statements and balance sheets. And also, if I know that they're going to have to pay estimated taxes, in that email, I put a blurb about what's going on. And if they have to pay estimated taxes, if it's issues, I do payroll services as well. So if it's issues coming up with their payroll services or their payroll taxes, I also on a monthly or quarterly basis put that in there as well. And then every time I do their payroll, I'll let them know what's going on as well.
Wow.
So they send me, I have access to all their information. If it's something in detail that I need from them, a receipt for more information, they'll just either upload it to the portal, to the secure portal, or they will email it over to me or drop it off, or we'll meet up and drop it off, or whatever the case may be. I have files for all of my clients. And yeah.
Wow. Okay. That's awesome. So I guess, okay. So I have two questions off of that. If, you're someone who's just like, what, I think I can keep my own books, but, I want to go to Michelle and just make sure that she, gets my tax returns right. And, I'm going to try to keep them on my own. Do you have any advice for people keeping their own books and how you would like to receive them when preparing their taxes at the end of the year?
I actually have clients that do that. So I just explained to them that's perfectly fine. It's great that they're learning it because it's a part of a business. So I explained to them at the end of the year when I'm about to do their tax return, this is what they have to submit to me: a spreadsheet. Okay. And a spreadsheet has to be one spreadsheet of revenue. And if you have revenue coming from multiple sources, it needs to say revenue. And it needs to say, let's just say, I don't know, let's say if it's service revenue, or let's say canceling revenue. This is your canceling revenue, or this is your product. If you sell t-shirts, this is your product revenue. I need to know what's your sources. Or if you have one thing that you're doing, then, hey, this is just your service revenue. But your expenses, I need a spreadsheet with your expenses. It needs to say expenses. Then it needs to say office supplies. The total for the year is this. It needs to say utilities, the total amount is this. Equipment, the total amount is this. They have to be extremely detailed, and they have to submit that to me and by December 15th, just so that I can review it and say, hey, you're on the right track. And that way, come tax time, when they submit it, they know they're on the right track and they have everything together. Because during tax time, they submit something and it's wrong, then it's going to take a while for us to fix it. So I just tell them, come with your detailed spreadsheet. If you have questions about something, come with all of that. And then just make sure you are detailing out what your revenue and your expenses are, and have your W-2 forms, have your 1099 forms, how about whoever you're going to file, your bank account information, and all of that information with you. This year was a little bit different because they had all that rebates and all that stuff. So it was a little bit different. My thing is, if you're a new client, I tell the new client to come with or upload to the client exchange portal a copy of their previous year tax returns, because, hey, that's going to help me get acclimated to who they are. What did they used to do and everything, so I can understand them and I can contact the IRS about them and get some, or the state, and get some other information. So now it's going to help me load it into the system so that I can see what I can do best for them to put more money into their family's pockets.
Okay. You just said something about like the rebates. I don't know if you meant like the stimulus, but that just, that for me sparked a question. Is that considered income on people's tax return? Or that's just, how is that? How is that going to be considered? Because people got free money. And
let's just say this. The verdict is still out for next year, 2022. Okay. But I do know for this year, when we were doing tax returns, the couple of questions they asked you was, did you receive the first and the second stimulus check? Because if you did not, you can get a rebate and they'll give it to you. Okay. So the verdict is still out. I should receive my full documentation from the IRS within the next week or two. They give us a 400 or 500 page document, booklet of what's going to go on for the next tax season. I'm not sure if they're going to add that, but it's a slight chance that they may not add it because of the pandemic that we were in. So it was free money. SBA was giving free money as well. So they may not add that. Now, however, let's go back. this child tax pandemic money that people was getting every month, July to December, that gets cut off in December. A lot of people are not understanding what they call that. They call that an advance on your tax return. An advance on your tax return means they're pulling from your tax return for the future and giving it to you now. And I tell people, so when I brought it to them that way and let them understand, a lot of individuals came to me, it was like, advance, it means this. Let me tell them, don't give it to me. So a lot of people was like, yeah, this is advance. I don't want that money back. I don't want that money right now, because all you're going to do is take it back next year. It was an advance on your tax return. So that was just that child tax money. But the other pandemic money, the rebate money and stimulus money, that's something totally different.
Okay. That's very interesting. So you had mentioned a while back when you were talking about your monthly bookkeeping, how you can tell people when they're going to owe, right? Like, it's because, I run my business. I am a independent contractor that works for my business. So I know a lot of people also run businesses that way, and at the end of the year, you're not careful, you need to have some money put aside, because you're gonna owe something, and do you have, I guess, maybe a strategy or something for people in a situation like that, to just make sure they put X percentage to the side, per month or per quarter?
The strategy is get you a good bookkeeper. Or if you cannot afford a good bookkeeper, your strategy is be mindful of your revenue minus expenses. So if you know that in your consulting business that you're going to make, let's say $5,000 a month, your expenses is going to be, let's just say $1,000, you're going to surplus every month $4,000. So you need to know that, okay, you're going to surplus $4,000 a month. What else do you have to subtract from that? Do you have any kids? Because that'll help. What else really do you have? Do you have mileage write-off? Do you have a office space to write off? If you don't have all that, then you do know that you need to pay estimated taxes to the feds, and you need to pay estimated taxes to whatever state you're in. Depending on your situation, whether you're married, whether you're single, that all plays a fact. It goes by different percentages. So I ask people, are you married? How's your W-2? Are you filing kids, or are you single? And I ask all those questions for a reason. Before we even do an agreement, so I'll know what tax situation they're in, because it helps me, hey, with their federal taxes, their estimated taxes, should I make them pay 25% of whatever they surplus? With their state taxes, should I make them pay 15%? Because it's going to help you in the end.
Okay. I think you've answered all the questions that I have. I don't see any in the comments. No one has any questions today about any of this stuff before we get out of here. I'm going to say that that's a no. Well, I definitely appreciate your time and your wisdom.
Thank you.
Yeah, you dropped a lot of gems, and I can't wait for this podcast to actually come out, because I think it's going to be a game changer for a few people, because I think that's just a lost idea, and especially in the music community, that you can incorporate yourself, and everything that you're spending money on can be a business expense, so it doesn't hurt as much, financially. So anyway, thank you again for coming on. And
thank you for having me.
And I will include all of her contact information in the description of the podcast, as well as the YouTube link. Okay? Take care.
Take care. Thank you.
Bye-bye.
Letting on the leaks on loud. I go based on tongues. Letting on me.